Okay. So any further questions or issues related to the disclosure? Like I said, I don't like lecturing disclosure because it's really, if you can do the calculations, then if you can calculate the closing balances, then if you can calculate the closing balances, then it's easy just to go and do the disclosure and put the amounts in where they should go. Good. Cool. Now we get to the tax, the income tax for a finance lease for the lessor. What is the difference between the tax treatment and the accounting treatment? So as we said previously with the lessee as well, for our purposes, all our lease contracts are going to be lease agreements from the viewpoint of the revenue services. So therefore, we're not going to have any installment sale agreements for accounting purposes. All our lease agreements are going to be lease agreements, which means, yes, and I see that Mr. Du Plessis has already said that we will not have, for accounting purposes, we will not have depreciation because, remember, we de-recognize the asset. We don't have that asset anymore from accounting purposes, for accounting purposes. On the commencement date, we de-recognize the asset. But SARS says, well, I don't care what journals you did, and from our viewpoint, you are still the owner, therefore you are going to get a wear and tear allowance, whether you want to or not. You're going to get that. Okay. And then for accounting purposes, the only income that we will have will be finance income that we are going to receive, whereas SARS says, no, you are receiving a lease payment, and that lease payment amount will be taxable. So on the full lease payment that we receive, we are going to have to pay tax on that. Okay. And then also for accounting purposes, let's see, what did I want to say here? Oh yes, for tax purposes, if we had initial direct costs, we will be, well, I'll tell you in the question that it's deductible when the initial direct costs are paid. Whereas for accounting purposes, that's actually going to form part of my net investment in the lease, because remember that initial direct costs decreased my unearned finance income. So it's part of my net investment in the lease. So that means it's going to go to my P&L in future as finance income, whereas for accounting or for tax purposes, it will be deductible in the year that we incur those expenses. Okay, so that means that again we have a situation where this lease transaction is going to affect my current tax calculations, and I'm also going to have deferred tax consequences from this lease agreement. Okay, so in example 15 again uses exactly the same information that we used for example 13. And 12 and all the other examples. So now again, this 15,000 is a final payment. Okay, so it's not an unguaranteed residual value, it's a final payment, balloon payment. And again, our lease year and our financial year are not the same. What the additional information that they give us in this question, they tell us that we've got wear and tear allowances at 10% and that it is prorated for a period of the year. And they also give us our profit before tax for the 2 financial years. And now we have to go and calculate what our current tax and our deferred tax is going to be. Okay, Mr. Armstrong, I see your question there. I'm going to get back to that. Let's just quickly deal with the tax. Okay, quickly deal with the tax, and then we'll get to the detailed calculations. And we'll go back and look at the detailed calculations if we have time. Okay, they also tell us that in 2014 we had some dividend income, and 2015 we had to pay some fines. So that's the information that we have in example 15. Now we have to do the tax. Okay, so here for our current tax calculation, we start with our accounting profit before tax that they've given us, and we want to calculate what our taxable profit should be. So now we have to remember, okay, so what happened for accounting purposes? So in the 20x14 year, for accounting purposes, we would have had some we would have had some interest income, and that would be that 8589 for the 3 months that we released because we've earned it. So we have to reverse that, because remember, the receiver says, sorry, I don't see interest income, I only see lease payments. But we would not have had any lease payments yet, because the first lease payment is only going to happen in the next financial year. So what else would we have in 20x14? There won't be, so in 20x14 we will also have wear and tear. So for that asset, also just for the 3 months, we would get a wear and tear allowance for tax purposes. Okay, so that's what's going to happen in 2014. In 2015, the same. We would have an interest income that we would now have to go and reverse. We had that for accounting. We want to reverse that. We would again have a wear and tear deduction, but now we will have a lease payment that we have received. So these are the adjustments that we have to make. I hope I now remembered all of my adjustments. Which one did I forget? 1, 2, finance income. Yeah, okay. So I remembered everything. Just quickly delete that. Okay. So those are the adjustments that we had to make. We had to, first of all, say for accounting purposes, the 8589 and the 33057, that was the finance income for the 2 financial years that we are now going to deduct to get that, because these finance income amounts were included in my accounting profit before tax. So now we deduct it to get rid of it, to eliminate it. And then we say, okay, what was the tax treatment? The tax treatment is we are taxed on the lease payment amount. Remember, in 2014, we have not yet received a lease payment. That's why it's 0 over there. And then we get our wear and tear allowance for this. This will be for 3 months, and this will be for a full year. And we also have our initial direct cost. That's the one I forgot about. The initial direct cost that will be deducted for tax purposes. Okay, yes, thank you, Mr. Swanepoel. You picked that up. Okay. Good, but just note that I didn't have the solution in front of me, but maybe you also didn't, which is fine. Okay, and that then gives us our taxable profit, as easy as that. So we reverse the accounting to get rid of it, so that we can add the tax treatment to calculate our taxable profit for these 2 years. Okay, now if we look at the deferred tax, so what happens for deferred tax? Remember, we put all of our assets and liabilities in our deferred tax. So the carrying amount, obviously we don't have the machine anymore because we de-recognize the machine, but we have a net investment in the lease. So that's our carrying amounts that we will put into our deferred tax calc. Now, what about the tax basis? Tax base for an asset is going to be the amount that will be deductible in future. Okay, because we are going to use, the lessee is going to use this machine, and for qualifying purposes, we are going to get wear and tear deductions. So the wear and tear deductions that I'm going to get in future will be the 292,500. Let's see if I've, okay, so that's the calculation of my closing balance for my net investment in the lease. There's my tax base for the asset. So the total cost was 300,000. We have received 3 months worth of wear and tear in the current tax calc for 2014, giving us then a tax base of 292,500 over there. That's the future deductions that we are still going to receive. So that gives us then a deductible temporary difference, giving us a deferred tax asset. For the net investment in the lease, the deductions that I'm going to get in future with regard to the net investment in the lease, nothing. We're not going to get any deductions for that net investment in the lease. That's why the tax base is 0. That gives us a taxable temporary difference and a deferred tax liability. And the net of these two is 4,925. And yes, you are welcome in a test to only show this line. You don't have to split it between the machine and the net investment in the lease. Okay, so that gives us then our deferred tax. Why do we remove the finance income in 2015 as we received and have to pay tax on it? No, but we don't pay tax on the, so the question that he has relates to the current tax calc. So asking, why do we remove the finance income over here. Remember, we don't pay tax on the finance income. We pay tax on the lease payment that we have received. And yes, this 80,000 lease payment that we have received is now going to include a finance income as well. But now, because of my finance year and my reporting years are different, the finance income component over here is not going to be the same as the finance income that was recognized for accounting purposes. So if we had a situation where our lease year and our financial year was exactly the same, then we could have just additionally added back the capital portion of my lease payment amount. Theoretically, we could have done that, and that would have given us then the taxable amount. However, don't do that. It's just much easier to think first, okay, reverse accounting, put in the tax. Okay, because if you now calculate this amount, there's only going to be half a mark for this 80,000 because I've given you the lease payment amount. So if you now do something wrong and you calculate this amount wrong, you're losing that half mark. So that's what I'm saying, rather reverse the accounting completely, the accounting income, and then we put in the taxable amount. Okay. Good. And Benola also answered you that. It's included in the lease payment, so we don't want to deduct it twice. Good. Okay, then Mrs. Swanepoel asks, is it incorrect to split the net investment in the lease between gross and unearned finance income and the deferred tax calc? Mrs. Swanepoel, I think I've answered your question there as well. Why don't we have a carrying amount for the machine in deferred tax? Okay, remember that we have de-recognized that machine, as Mr. Du Plessis have told you. We don't have that machine anymore. So for accounting purposes, there is no carrying amount. That machine does not exist on our SFP. We've exchanged that for a net investment in the lease. Okay. Why was the wear and tear apportioned for 2014? Yes, because the required told us, we go back to our information here, they told us that it is prorated. Okay, so the wear and tear is prorated. I will tell you whether it is prorated or not. Good. Okay, and then just the same calculation that we do for 2015. Again, our machine has a zero carrying amount, but the net investment in the lease will have a balance. And how did I get to that closing balance net investment in the lease? So that will be the 255,857 from the amortization table. So it will be amort 11 balance. So after the first lease payment, the balance, but then we have to add the 3 months additional unearned finance income that we have actually earned. So by releasing it from unearned finance income, we are actually increasing the carrying amount of my net investment in the lease. So that's why I'm adding it here to get to my closing balance of 263,146. Okay. Good. So that is then the deferred tax, and there's our tax base 262,500 after the wear and tear that we would have received in 2015, giving us tax base of 262,500. Okay, question from a Swanepoel, is the tax base of the net investment zero because the future payments will be taxable and nothing will be deductible? Yes, so there's nothing deductible with regards to the net investment in the lease, but we are getting deductions in the form of wear and tear allowances. Mr. Groenewald, depends on the class for asset or machine if it's apportioned or tax. Okay, thank you. But like I said, we think up our own tax law in a FRK 300 question, so we will tell you whether it's apportioned or not. Okay, so that's the deferred tax. Any questions further? Let me just check. Any further questions on deferred tax? Yes, I saw that, Mr. Groenewald. Thank you. So, yeah. Okay. Okay, so then we've got a few minutes left, so I just want to quickly touch on, to tell you about a manufacturer or dealer lessor. Okay. So what is a manufacturer or dealer lessor? So I told you up to now we've looked at just a normal finance lease, which is an incidental lease. That's where the entity is just has an asset that it's not using at the moment, PPE asset that it leases out. Now we also have a manufacturer or a dealer lessor. So either this lessor manufactures the assets that it leases out, or it deals in the assets that it leases out. So it purchases this asset and leases it out. That's why it's a dealer lessor. Okay, so what is a manufacturer dealer lessor? We said that normally up to now we've looked at the incidental lessors. Now this manufacturer or dealer lessor actually has inventory that it leases out. It either manufactures the inventory itself and then leases it out, or it deals in the inventory, purchases it and then leases it out. Okay, under a finance lease. Now in paragraph 72, they tell us that a manufacturer or dealer, they explain to us what a manufacturer or dealer lessor is. So manufacturer or dealer lessor will either give the customers the choice of buying this asset for cash, or otherwise the customers can lease this asset from them. Okay, and that means that for a manufacturer, dealer, or lessor, there will be profit or loss on the transaction. Now you would have seen that for my incidental lessor, there was no profit or loss. We just had our finance income that we received. But now, because it's actually the business of this manufacturer or dealer lessor to lease out its inventory, there will be profit or loss that should be recognized as well. Okay, and this profit or loss we should still recognize regardless of whether the customers are buying it for cash or leasing the asset. The profit or loss should still be recognized at what it would have been if it would have been an outright sale. Okay, so that means that my manufacturer or dealer lessor actually has two income streams: profit on sale and finance income. So two different income streams. Okay, so what are the differences then? What's the differences in accounting for a lease for incidental lessor to a manufacturer or dealer lessor? Now, there are just three things that you have to remember. So the first thing is that if you look at the definition of initial direct costs, you will see that initial direct cost specifically excludes initial direct cost by a manufacturer or dealer lessor. So the initial direct cost of a manufacturer, dealer, lessor just goes straight to cost of sales. It's just expensed the moment it's incurred. The next, there's the definition. Okay, so it's the definition specifically says, except for such costs incurred by a manufacturer or dealer lessor. So specifically excluded. Okay, then. Second difference has to do with initial recognition journal. So what's going to happen for manufacturer or dealer lessors, we're going to have two different journals. We are going to have one, because we've got our two revenue streams, so we're going to have one journal for our revenue, and then we're going to have another journal for our cost of sales. So the normal way, when we always have sales, we always have those two journals, and we are going to do that in the manufacturer, dealer, lessor as well. Okay, and then the third difference is we will have additional disclosure because of the fact that we now have this profit on sale as well. Okay, so okay, I see the chat box is going on, but it seems that it's all about tax. So obviously tax is consuming you guys at the moment. But it is nice to see, to think a bit about, to link the tax and the accounting, to see how those things are linked. Because next year there will be a lot more integration when it comes to the different modules. But for now, I don't see any questions related to manufacturer or dealer lessor for now, so we'll just carry on with that. FPS and auditing, that's consuming us. Okay. I think I can feel your attention wandering, so I think I'm going to stop here, and then we'll do the manufacturer or dealer lessor. We'll look at that in tomorrow's lecture at the beginning. Note that also the manufacturer or dealer lessor is at an awareness level for SAICA, which no one knows actually what it means if SAICA says something is at an awareness level, so you should just be aware that there are differences. That's why you'll also see that we don't do the tax treatment for manufacturer or dealer. We actually make it a lot more straightforward, but you just should know about the differences there. Okay, so I'm going to stop here, and we'll talk about manufacturer, dealer, lessor in tomorrow's lecture. We'll start with that because I can feel your concentration levels wandering. But maybe we should go back to the examples that we did. We did go through it a little bit quickly. So Mr. Mr. Armstrong, you asked about example 14. Okay, so we're asking, question is an example 4, why don't you just use the interest rate implicit in the lease calculation and then use 2 input 5 interest in B? Okay. Oh, Ms. Swanepoel, I'm sorry. Did you ask a question? I see you being ignored. I'll get to you just now. Okay. One at a time. Sorry. Okay. So, Mr. Armstrong, why don't we just use 2 input 5 interest in B? Okay, now just remind me again, what was B? I don't have the examples in front of me, the detail of the example. Because the thing is, in this example, we can't just straightforward use our, oh, I see, you're referring to calculation B for the finance income. Okay, let us just quickly go out here and discard and go back in. So you're referring here to calculation B for the 66874. The thing is, you're not going to get to the same amount because of the fact that my financial year and my lease years do not agree. So did you get to the same amount there if you use your calculation? 2 input, so you are asking 2 input 5 interest. So your calculation then calculates the interest for these 3 years. Now, maybe an example 14, the lease years agree. So am I right, Mr. Armstrong? Did you get to the same answer? 113,500 less 34,357 79143. Yeah, I see you would not get to the same answer. Your thought process is 100% correct, except for the fact that you can't use your present value calc as is. You can't use it as is. And the reason for that, remember in your present value calc at the moment, we've got that future value of 15,000. So this 66874 will only be the unearned finance income on the lease payment. So that's why I said, if our financial year and our lease years were the same, then you could use your shortcut, but then you would just have to make your future value 0 so that you are only calculating the interest on the lease payments. And then do the same then for the 15,000 unguaranteed residual value. But your thought process is 100% correct. You can do that, but then you just have to take out your unguaranteed residual value. Okay. You would still need to make an adjustment if lease and finance, exactly, you still need to make that adjustment. Okay, sorry, Ms. Swanepoel, you are being ignored. Your question was, what about the finance income journal? Shame, and you asked it twice. I'm not sure, are you referring to, which example are you referring to? Sorry, Ms. Swanepoel, I missed it when you asked the question. So maybe you can just, for the manufacturer or dealer. Okay, like I said, let's leave the manufacturer dealer for now. We'll do that in tomorrow's lecture. And then we'll get to that. Okay. Because we just looked at, I just came up until initial recognition. So we'll look at that in tomorrow's lecture. Good. Okay, but how do we know not to make the 15,000 part of the lease payment? Okay, but because remember, in example 14, I changed the 15,000 so that it is now the unguaranteed residual value. So if there's an unguaranteed residual value, you are going to have this additional disclosure, this additional line item in your note. And you see over here we didn't have it. We didn't have that that amount. So because this 15,000, for example, 14 was an unguaranteed residual value, we had to disclose it. If it was just if it was a lease payment, a balloon payment, then it would be included. Okay, so Mr. van der Merwe, are you happy with that? Okay, Mr. Schmidt, what would happen, what would happen if the deposit is of such a nature that will repay to the lessee upon return of the asset? Well, then that is going to be part of your future value. You're going to have a negative future value, a payment that needs to happen at the end of the lease term. So that will be then included in your, we'll take that into account, and that will be included in your interest rate implicit in the lease. Okay, so then, yeah, you'll get to a negative amount at the end of your in future value. Okay, I don't see any other questions. Anything else? We've got 7 minutes left. Will it then also be part of the net investment in the lease? Yes, because that's then almost going to be treated like a lease incentive. If you look after the asset well, then you're going to get that back at the end of the lease. So it will be part of your net investment in the lease. Okay. Well, yeah, because it's going to be a negative future value, so it will be part of that. Now, it won't be part of present value, because present value, remember, is the asset that we are giving up, as well as any initial direct costs. So, yeah, and then you'll deduct the deposit paid on that day as well. Yes, you're right. So it will be part of the present value, and then you'll have it as a negative amount on a future value. I must admit, I haven't seen a question like that. It's an interesting one, but it can happen, and it does happen. Okay, cool. Any other comments or questions? Okay, I am here for another 6 minutes. So if there are any issues. Okay, otherwise I'm going to, I'll greet you, and those of you who want to go are welcome to do so. And then we'll see each other again tomorrow morning at, I think it's 9:30. Okay, so keep well, study hard, and see you guys again.